This Capital Advisors, John Luke Tyner is a portfolio manager and head of fixed income. John, good to have you on the show and a good addition to our conversation. So let's shift kind of the tech stuff. You guys have a fund that seems like it's kind of built for these moments when some of that momentum in tech falters.
Yeah, thanks, Oliver. Yeah, our shop is really based on being options based and being long volatility. And I think it's very timely with what you were just speaking through, where markets have been frothy. A lot of people are nervous about what could be coming in the future. And, I think ACIO, which just celebrated its fifth year birthday, is an actively managed product in the hedged equity space that doesn't make you give away all of your upside and still gives you the benefits of risk management and risk mitigation. And I think a lot of investors, especially in an environment where fixed income might not serve as that ballast for allocations, really could kick in.
Okay. Tell us about the function of the fund, the kind of structure behind it. How big is that collar that you're putting on it?
Yeah, so really the structure, it shifts the math with how we position the collar. So we're long about 75 stocks. The key difference is we're selling calls typically on the single stocks inside of the portfolio instead of on the index like most of the legacy products. And we're buying puts on the index that are typically about 5% out of the money, give or take, depending on the market environment. But what you see with that structure on a typical market, and obviously Zed pointed out some things that I think we could definitely discuss, but typically we're raising the ceiling of the strategy and allowing for more upside capture. And so what that looks like is more of a 70% upside capture versus a 50% or less downside. And that's typically what we're shooting for.
Okay. Now, as after you get a few of these days where the market skews away from tech as hard as it has today, a 3.5% spread of the Russell, last week a big spread too, that allows you to then brace for a little bit more kind of upside then? Or do you kind of move with price momentum where you go, okay, weakness, we need to be careful about the downside? Or is it more we kind of assume that things come back and dips get bought?
Yeah, so the fund is structural in terms of how we're managing it. So I think like we're not making a guess that, hey, the small cap rally is going to continue. I think the important thing for this backdrop is the cost to hedge a portfolio is extremely cheap right now. And so you don't have to sell as many calls against the upside, giving away the upside that you might typically have to do in an environment where the VIX is at 20. And so one of the reasons that we've been successful this year specifically is we haven't had a substantial number of names capped to the upside. And that's been effective in capturing about 90% of the market up for the year.
Okay, that's super helpful as puts get pretty cheap, right? You don't have to sell as much. You can capture more upside. So then I guess you're kind of the man to ask on the skewness then. Are we getting VIX up because people are buying so many calls over puts?
I think that's certainly an implication of it. Maybe you've got some people missing out. You've got people that are off sides and positioned overly in tech and trying to keep up with this move. And I think it definitely plays an impact with pricing of options. And, overall, what ultimately matters is are you protected, in our opinion, against the large potential drawdowns that could come given future uncertainty. And I think how the portfolio across ACIO is really it just provides an option that investors can sleep at night knowing that they have guardrails in place.
Okay. And John, when you guys think about this in terms of the broader portfolio, I mean, it's equity replacement, or do you view it as with the collar? Do you view it as fixed income? I mean, what is kind of or just income in general?
Yeah, so we don't distribute the income from the short call book. So the products run inside of an ETF. It's extremely tax efficient, taking advantage of the different ETF wrapper rules. So that's a big piece. But how we typically see investors use the product is either for the guy that wants to stay or needs to stay invested in equities, but just can't stomach the risk, where they've got that protection in place that's actively managed, or as a replacement across an asset allocation situation where, we've seen how ugly fixed income has been. If heaven forbid a year like 2022 happens again, I think a lot of people are off sides. And when you own a hedge on the market, you've at least got a piece in your portfolio that's going to be negatively correlated to stocks. And so we've seen a lot of investors take some of the fixed income allocation and replace it with a product, with ACIO.
Interesting. All right. Well, we're certainly going to get some juice in your bond portfolio this way for sure. But doing pretty good, just keeping up with stocks generally as well. John, thanks for the conversation and a really good perspective, a timely one.
Yeah, thank you, Oliver.
Absolutely. John-Luc Tyner, portfolio manager and head of fixed income at Aptus Capital Advisors. ACIO is the fund, up just shy of 18% on the year.